All right, good morning.
Good morning.
Good morning.
Good morning.
Yeah, there we go. We're going to talk about the Federal Reserve Bank, so we're going to have more energy here this morning. It's my pleasure. I'm Brian Ryan. I'm the Senior Vice President of Effectiveness and Innovation here at the college. And it's my pleasure to introduce our speaker for today, Rick Kaglic. As you can see on your program, Rick is a Senior Regional Economist at the Charlotte branch of the Richmond Federal Reserve Bank. He joined the research department in 2009, and he's responsible for analyzing regional economic conditions and developments, as well as educating the region's diverse consultants in the role of the Federal Reserve and its district banks. So Rick is here today to help educate us about the Federal Reserve banks, and I think one of the things that I would suggest you to do is listen carefully, because the Federal Reserve Bank is a little bit strange. It's a little bit unusual as an agency, and he's going to tell us more about that Federal Reserve Bank. It's independent, but it's also connected with our government. So he's going to tell us more about that today. Rick has a long background in a variety of fields related to economics. He was a senior economist for the Eaton Corporation. So he worked in the private sector. That's a Cleveland-based manufacturer. He was chief economist for the Washington State Employment Security Department. He also spent 11 years as a senior business economist at the Federal Reserve Bank of Chicago. So in addition to the Federal Reserve Bank in Richmond, there's a Federal Reserve Bank in Chicago, and Rick will tell us about the other Federal Reserve banks out there. And he used to write for that Reserve Bank of Chicago, the Beige Book. So the Federal Reserve is so exciting that they have a book, and that book is beige. Yeah, I'm here all week. Although Rick works for the Richmond, Virginia Federal Reserve Bank, and he happens to live in South Carolina, he is committed to improving North Carolina. And I know this because he and I were in the Leadership North Carolina program last year, and Rick is currently, he's a graduate of that last year's program. He's currently working with that program this year to organize their economic development session in New Bern, North Carolina, to help create better leaders for the future who have an idea of economic development and economics. Let's give a Wake Tech welcome for Rick Kaglic.
So Dr. Ryan mentioned the Beige Book. It wasn't always called the Beige Book. It was actually called the Red Book. But in 1983, Congress wanted a little more transparency from the Federal Reserve Bank. And so there was a congressman named Walter Fauntroy. He was a delegate from Washington, D.C. And he went to Congress and he said, I want more information from the Federal Reserve. And the Fed was compiling what we refer to as the Red Book at the time. And can anybody guess as to why we called it the Red Book? The cover was red. So when Walter Fauntroy, who, by the way, I think was recently thrown in prison, when Walter Fauntroy requested this information, the Beige Book is kind of this compilation of information that comes from business leaders that we talk to. And so we said, okay, fine, we'll release this to you, but we had to do a couple things to make it more consumer friendly for a general public, as opposed to the presidents of the Federal Reserve System, those who were sitting around the table making decisions on monetary policy in the U.S. So one of the things they had to do is they stripped out all references to people and business names. So for example, if we were talking to somebody at General Motors, and General Motors was telling us about input prices that it had an impact on the economy, we would just change that and change who the person was. So we'd say something like a large automobile manufacturer told us blah, blah, blah. But another thing that they did was they changed the cover color. Apparently red gives this intonation that there's some kind of red flag, right? There's something to be concerned about here. So we went with a beige color on it. And And it's about as interesting as the beige color might suggest it is. So if you ever want to read something really, really interesting or help yourself sleep, go ahead and read the Beige Book. So Brian, thank you very much for that introduction. Thanks for you folks for coming out this afternoon. It is a pleasure to be here at Wake Tech College. So we're going to talk a little bit about the Federal Reserve today, but what I've done is I want to do three things really today. I want to talk a little bit about the Federal Reserve, what it is, why we have it, and how it's structured, but mostly how it impacts your life. Secondly, I want to talk a little bit about what's going on in the general economy, why the economy has been growing at a pace that is, most folks I think would say ungratifying since the Great Recession ended in the middle part of 2009. And then finally, I want to finish up by talking about how you, in getting your education here at Wake Tech, how you impact how we do business and how you impact the economy more generally. So let's begin by talking a little bit about the history of the Federal Reserve System. So first of all, does everybody know what the Fed is? The Fed is our nation's central bank. Did you know it's not our first attempt at the central bank? We didn't always have a central bank in the United States. This is actually our third attempt. We had the first Bank of the United States was chartered from 1791 to 1811, but the political climate was such at the time that the folks had a deep distrust of two things in this country: centralized power and concentrated wealth. Seems like some things never change in the United States, right? So the notion of a central bank was not real popular with people. They just, and particularly in Congress, they weren't particularly pleased that we had this institution that was really just centralized financial interests in the United States. So the first Bank of the U.S. didn't get its charter renewed. So then it took 5 years. They tried it again. So then we had the second Bank of the U.S. Both of these, by the way, were headquartered in Philadelphia. Second Bank of the U.S. had a charter from 1811 to 1831, and then in 1831, its charter was not renewed. So we had this period between 1831 and 1912 where we had no central bank in the United States. And it was a period that was characterized by a bunch of financial panics. There were no fewer than 22 financial panics that took place in the United States in that period. Well, one of the big problems that we had in the US was we didn't have a common, much less flexible currency. That is to say that at one point in time in our history, we had more than 30,000 currencies that were floating around simultaneously. So some regional bank may be issuing its own currency, but if they had to take that currency and you wanted to go purchase something outside of that bank's region, you might have trouble making your payments. In addition to not having a common currency, it wasn't flexible, so the currency in the country couldn't expand and contract with the needs of the economy. And keep in mind, back in this part of our history, especially in the late 1800s, early 1900s, we were still largely an agricultural-based economy. And think about the cycles when it comes to agriculture, right? Farmers plant stuff, they work the land, later on they reap what they sow. Well, when they're reaping what they sow or when they're planting, they need more money. If the banks did not have that money, what would happen was the farmers would go to the bank, say, I need something to help me to get through this process. We're a little short here, I need to make a loan. I need to borrow some money. The bank would say, well, gee, we really don't have sufficient funds on hand because there was no flexibility in the money supply in the country. So what would happen is if they wanted to satisfy the loan to the bank, they may have to call in loans from somebody else. And when they would try to do that, they'd call in loans for people, again, largely agricultural based. They couldn't afford to pay the loans right away, so they would declare bankruptcy. And at the end of the day, everybody would kind of get shafted. The farmers couldn't pay their loans, the banks couldn't survive, and you lost your money. So in 1907, after a particularly harsh financial panic in the United States, Congress decided to look into the formation of an institution which would be kind of used to counteract these financial panics and establish a common currency for the United States. The commission was called the National Monetary Commission. And there was a roughly 7-year debate that followed between, on one side, you had the Northeast financial interests, And to no one's surprise, the people in the Northeast financial interests, they all wanted a highly centralized institution in which bankers would be in control. And then you had the agrarians, the populists, and pretty much everybody who was not a banker who didn't trust the centralized financial interests, and they wanted a more decentralized structure in which the public sector would have considerable say. So what ended up happening was we had the Federal Reserve Act was ratified in 1913. And the influence really of both sides of this debate can be seen in both our functions and in our structure. So this graphic shows a map of Federal Reserve districts. We have the Board of Governors in Washington, D.C., which is given by the star here. And we have these 12 district banks located throughout the country. Interestingly, the Board of Governors in Washington, D.C. is the only federal government part of the Federal Reserve System. The Board of Governors in Washington, D.C. is actually an independent agency within the federal government. So ultimately it answers to Congress. The 12 district banks located outside the D.C. area, each of them operate as kind of nonprofits. We are not federal government employees. I tell my dad this at every holiday gathering because he insists that his tax dollars are paying my wages. They aren't. We are an independent agency. So we are a decentralized central bank in the United States. So we've got the Board of Governors in Washington, D.C. That is the federal government component of that. The Board of Governors consists of 7 members. Each of them is appointed by the President of the United States and confirmed by the Senate. They each have a 14-year non-renewable term with one term expiring every 2 years. The reason for that, the long terms and the expiration cycle, is they wanted to, Congress wanted wanted the president to have a say. So when presidents are changing out every 4 or 8 years, they wanted to make sure that there was a healthy ideological flow. So if a Republican came in or a Democrat came in, they would have an opportunity to appoint at least 2 Fed governors. The 14-year terms were designed to ensure that those governors, once they were put in place, were free to exercise their judgment in a way that is consistent with longer-term economic objectives, not short-term political goals. So each of those governors has a 14-year non-renewable term, one term expiring every 2 years, and then the president picks from amongst the 7 members of the Board of Governors the chairman of the Federal Reserve System, which currently is Janet Yellen. Now, when it comes to the reserve banks, the bank that I work for, the Federal Reserve Bank of Richmond, we actually are governed much like any large corporation. We have a board of directors, much like any other large institution. We've got 9 members who sit on that board of directors. But what's kind of interesting to note is you can see the influence. If you take a look down here at how our directors are elected and who they represent, you can once again see that the influence of that debate back in the early 1900s. This distrust of bankers and folks wanting to have the public sector have a say in what happens. So what do we do? What does the Federal Reserve do? Well, the Federal Reserve System, everything that we do is geared toward maintaining a safe and sound financial system and a healthy, growing economy. But we impact your life every day because we have control over interest rates. Some of them shorter term. More recently, during the Great Recession, we actually went out and affected longer term rates more directly. But we impact interest rates, and interest rates impact how you think about saving money, spending money, how businesses want to invest their money. So we affect the economy in 3 primary ways: through our supervision and regulation function, through our payment services, and through the conduct of monetary policy. And by the way, if anybody has any questions at any point, you want to ask those questions, please feel free to. We'll stop and talk about it. So let's start by talking a little bit about bank supervision and regulation. So as I mentioned earlier, Congress actually controls what happens with the Board of Governors. Well, Congress actually writes the laws. So the Dodd-Frank Act, for example, was written by Congress. but they left it up to the Federal Reserve System to kind of interpret those rules. So the Board of Governors in Washington, D.C. actually writes those regulations. Then it is up to the district banks to enforce and monitor banks and make sure that they are abiding by those regulations. So when we look at the Federal Reserve System, we are just one of several regulators. There are other banking regulators at the state level, at the federal level. Sometimes we overlap in those, but it's a disparate system. With the Richmond Fed, we monitor 75 state member banks, and the 5th Federal Reserve District includes Maryland, D.C., North Carolina, South Carolina, Virginia, and the better part of West Virginia. We don't get all of West Virginia. Ohio's got a little part of West Virginia. So we monitor the 75 state member banks, and there are 250 bank holding companies in the 5th Federal Reserve District that we are responsible for making sure that they do not take on too much risk. The examiners, when they go out, they look at a variety of different things, but the primary function in this regulatory and supervision role is that we want to make sure that banks don't take on too much risks. I mentioned earlier about the financial panics, right? Well, one of the remedies to financial panic that came out in the early 1900s was deposit insurance. Everybody knows that you have deposit insurance, right? You take your money to the bank and you deposit it into the bank, and the government says, well, we will insure that money up to a certain level. Well, while that is certainly helpful, it helps on bank runs, because when we're sitting here and we see that our money may disappear from a bank, we don't feel the urge to run out there and get our money out, right? We know that somebody's going to pay it. It's going to be the taxpayers, but somebody's going to pay us back. But there's an adverse side effect to that. And the adverse side effect to that is, once you deposit your money, you know that it's safe, so then you really don't care what the bank does with it to earn a profit. You don't care about the risk that they're assuming. Well, somebody has to watch it, because ultimately, banks can and they will lose money, and they can lose depositors' money, even though it's going to be paid back by the federal government. So that's one of the key roles that we have. Since you don't care what happens to your money once it goes to the bank, somebody has to watch the banks and make sure that they're not taking on too much risk, and that's what the Federal Reserve System does. We are also the banker to banks and the federal government. So we provide a lot of financial services in the economy, and we make sure we manage the nation's payments system. So you will notice up here we have a picture of a $100 bill. You'll notice up in the upper left-hand corner it says it is a Federal Reserve note. That means that that money is exchangeable at the Federal Reserve for currency. If you come in, for example, and you want you have an electronic blip in your payment, you want to convert that into cash, we are obligated to do that one for one. But we don't make money. We don't make the money. The currency and coin that you have, that's done by the U.S. Mint and the U.S. Bureau of Engraving. But we do distribute the money. So when the federal government wants more money to go out in circulation, they will bring it to a Federal Reserve Bank. Here you can see it says Federal Reserve Note. There's a little identifier here, and this is the new $100 bill, so I have to actually find it. Oh, okay, up here, B2. There's a demarcation of which Federal Reserve Bank that dollar initially went to. So B2 is the Boston district. That's the second Federal Reserve District. If you see a 5E, that means that bill came from Richmond. But again, we don't make the currency or coin. We distribute it to financial institutions so that they have enough on hand. We also clear checks. Did you have a question, please?
Yes, you hand out money. Do you ever come to the banks and take it back?
We take the money back as well. And when we find that the currency is no longer suitable for circulation in the U.S. economy, we take it and we destroy that money. So if there were fewer people here today, a more manageable crowd, I would have brought shredded money because just like, there's a limited supply of money in the economy, in the global economy. There's a limited amount of currency out there, and we've got to make sure that we protect the value of it. So when we put more out, we've got to make sure that we're taking some in and getting rid of it. So good question. We also clear checks, electronic payments. We provide some services to the U.S. Treasury. So, example, when you get a check from the IRS at the end of the year, that's actually coming through the Federal Reserve System. But take a look at this. One of the most important jobs we do is maintain our nation's payment system. So you ever wonder when you go out and you are making a payment at a store, you've got your little debit card, you run it through, you swipe it through, put the chip in now. You ever wonder how it gets from there, takes money from your account and places it in the merchant's bank account? That's largely done through the Federal Reserve System. So this is what we do on a daily basis. FedWire is a big automated an electronic system. It is low volume, very high dollar values payments. Then we have automated clearinghouse, which are the opposite. So these are small but very frequent payments. Think about Social Security payments. If you're getting a monthly check, those types of those payments through our automated clearinghouse. And then of course we have cash notes and checks and all that fun stuff. But here's the interesting thing when you get down to the bottom line here. This is on a daily basis. On a daily basis, the Federal Reserve System clears about $4.5 trillion worth of payments. $4.5 trillion worth of payments. So it's a huge responsibility. And of course, as you can imagine, now with more electronic payments going around, financial innovations, it's getting more and more difficult to do this, to do it efficiently, and to make sure we're doing it with as little fraud as possible to make sure that we're protecting your investment in your system. Check clearing used to be a huge part of what we do, but things have changed so dramatically over the last 10 to 15 years. This map shows where we had all of our check clearing facilities across the United States in 2003. There were 45 of them, 45 check clearing facilities, including one in Charlotte where I worked. Today, there's one. We have one Federal Reserve Bank, Atlanta, that actually clears checks. So the last thing that we do, and of course from an economist perspective, the most important thing that we do is we are charged by Congress with conducting monetary policy. Monetary policy is the actions taken by the Federal Reserve System to influence interest rates in the economy. Basically what we are doing is we are balancing the supply of money with the needs of the economy. I mentioned a little earlier, there is only so much currency, there is only so much money, so many US dollars available out there in the global economy. One thing you should know is that the money that you have in your pocket or in your account has absolutely no intrinsic value whatsoever. It has no value beyond what the government tells you it has and what all of us agree that it has. So money serves really three key functions in our economy. One, it is a basis for transactions, right? It's something that I'm willing to accept from the Federal Reserve in exchange for my services as an employee, and then I know that the dry cleaner is going to accept it in return for the services that he provides me. So it's used as a transaction. It's a good store of value, meaning if I put $1 in my pocket today, and a week from now, it's probably still going to be worth $1. Now think about some things that you buy for $1. Say you go out and buy a peach, put that in your pocket, see how much value it has a week later. So the dollar, the currency, provides you with a store of value. It also provides a unit of account. It is something that we can use as a baseline by which we can judge the value of all the variety of goods and services throughout the economy. It's something that we understand when we go in and say whether we want to pay $30,000 for an automobile or $1,200 for a computer or $1 for a peach. We all understand this value. And with that value in its unit of account function, money allows us to calculate up what we refer to as nominal gross domestic product, right? You all heard gross domestic product. That's the total output of goods and services. Well, all that is all of the stuff that we produce as a society multiplied by their respective prices. And that comes up with this dollar value. Now, that's nominal terms. We can deflate that to account for inflation and come up with real dollar terms as well. But another important thing to remember about money, not only does it have no intrinsic value, money does not make the economy grow faster. Money does not make the economy grow faster. It can't. So a lot of people think if the Federal Reserve would simply have pumped more money into the economy during the Great Recession, despite the fact that we pumped a whole lot in to begin with, that we could have gotten unemployment down a little lower, we could have made the economy grow a little faster. Money does not make the economy grow. It actually helps grease the skids, if you will. It helps the economy through its store of value, the transactional function, unit of account, makes it more efficient so that the economy can grow to its potential. But at the end of the day, folks, an economy is really nothing more than people producing stuff. It's people producing stuff. And the amount of stuff that you're going to be able to produce is determined by how many people you have producing it and how much of the stuff they can produce. So then the economy is going to be able to grow only as fast as changes in the workforce and changes in productivity will allow it to grow. Money has nothing to do with that. So our goal then was handed down to us from Congress with the 1977 amendment to the Federal Reserve Act. It incorporated what we now refer to as the dual mandate. So you'll see down here the dual mandate, and you actually see three things under there: maximum employment, stable prices, and moderate long-term interest rates. And some of you may immediately look at that and say, well, gee, that looks like 3 mandates, not 2. So here we've got a problem already, right? Economists can't even count. But here's how this works. We know that if we make sure the prices are stable, then the moderate long-term interest rates will follow. So as long as we keep prices low and stable, that means that interest rates are going to be relatively moderate and stable as well. That's why we refer to it as the dual mandate. But a key sentence in the dual mandate that's often overlooked is that it says that the Federal Reserve System is to conduct monetary policy conducive to its long-term potential to increase output. And people forget that oftentimes. They just look down and say, we want maximum employment and stable prices. But the economy, as we'll see in just a moment, has a natural born speed limit on it. And we'll talk about why that is. So, if we pump too much money into the economy, all it's going to do is lead to inflation. If we pump too little into the economy, it can stifle growth and lead to a recession. So, we have this kind of crude tool in monetary policy. Did I just hear feedback, or was that just my... Okay. We have this kind of crude tool in which we are supposed to fine-tune economic conditions in the U.S. economy. So we have this dual mandate where we are supposed to put or conduct monetary policy in a manner that is conducive to both low and stable inflation and maximum employment. Well, one thing we know for sure, and it's been an accepted theory since back in the 1970s, is monetary policy is a very effective tool for maintaining price stability. That is, over the course of history, you can take a look at the chart, and I didn't bring the chart with me, but I have a chart that shows growth in the money supply compared to inflation rates, and there is a clear positive correlation and causality. The more money you pump into the economy, the more inflation it's going to lead to. Because of that, the Federal Reserve decided it was perfectly acceptable to have a real hard target on the one part of our mandate. So inflation, we have targeted at 2%. We said we want to see inflation as measured by the personal consumption expenditures price deflator to measure 2% year over year on average over the medium term, because we know that changes in monetary policy will affect inflation. But when it comes to employment, it's a much more difficult animal to tame, because as I mentioned a little while ago, money does not make the economy grow faster. It's people making stuff. Well, how many people actually participate in the economy? It's a good question. How many people participate in the economy? We've got a lot of factors that determine how many employees we can actually have. And think about it, if this was a closed economy, you can think of one obvious impediment to growth right away, right? We only have so many people. And the number of people only changes slowly over time. So that's going to create an impact. So we don't have a long-term goal. We'll talk a little bit more about that later. But we mentioned up front, monetary policy independence. the way that the Federal Reserve System is set up is absolutely critical to our functioning, especially in the conduct of monetary policy. Now, have you all heard that there are efforts underway to audit the Fed? Everybody's heard that, right? You've heard that there's efforts underway to audit the Fed. Did you know that the Fed is audited in so many different ways? Virtually every aspect of what we do is audited, and by certified accounting firms, and we report those to Congress. There's one aspect of what we do that is not audited by Congress, and that is monetary policy. Now, why is it important to maintain monetary policy independence? Monetary policy can be an effective tool in the short run to boost employment. So if you have an economy that is running at its potential, that means everybody who wants a job has a job and they're all working 40 hours a week, they're all putting stuff out. We can actually boost the economy a little bit in the short term to grow above its long-term potential rate of growth. And so we can put more money into the economy, make some goods and services more affordable, like automobiles, for example, and you may rush out and you might want to buy an automobile. But think about back to what we said earlier about if this was our economy in here, we've got a limiting factor. We've only got so many people and so much equipment to produce stuff. Now in the short term, if you think about just the people in this room, we can actually make more stuff if we had to, if everybody's fully employed. We can work more hours, right? We can all work more hours. But how many of you are more productive in your 10th hour of working than you are in, say, your 6th hour? You're not, right? You're less productive. So if you're producing less and your employer is still paying you the same amount, that means it costs more for them to produce that good or service. So ultimately what's going to happen is that employer is going to start to demand more to recover the cost that they're losing for you working overtime. So in the long run, that employment is going to fall back to normal and all you're left with is going to be inflation. But if you had if the government had complete control over the conduct of monetary policy, and it still happens in the world today. Argentina is a good example. Reliably, just prior to an election, they will tweak the economy, make interest rates much lower, push out a lot of cash into the economy. People go out and they want to buy stuff, but they're limited by productive capacity. They can't necessarily make as much. In the short term, firms will try to keep up, but ultimately it's just going to fall back and prices are going to rise. But what happens is when you pump the money into the economy initially, you don't see the price increase. Prices don't adjust immediately. What you see is you see more jobs, you see the unemployment rate go down, you see more cars being sold. It's only after the election that employment falls back to where it was, unemployment rises, and all you're left with is inflation. So it's a very politically tempting idea to goose the economy just ahead of an election. That's why it's important for an independence, which allows the Fed to stay focused on those longer-term economic objectives and not the short-run political cycles. Now, can you imagine if we had to go to Congress every time we wanted to do something with monetary policy? How much has Congress gotten done over the last 6 years, 8 years? Can you imagine where that would be partly problematic? So that's why it's critical. So now let's talk about the economy particularly and why the economy has been growing so slow. This graphic shows real gross domestic product in the United States. Quarterly growth rates, these are seasonally adjusted annualized rates from 2007 up through the third quarter of 2016. And then at the end of that, you'll notice that there are some columns which have a little red diamond, for those of you who can make out that that's a little red diamond there. And that actually shows the Federal Open Market Committee's forecast for output growth out through the end of 2020. So let's get back to what the economy has been doing recently. In recent history, you see the Great Recession here, and then we've had a relatively steady economic expansion. A lot of volatility quarter to quarter, but over the course of time during this recovery, growth in real output in the United States has averaged just a little more than 2%. Now, this is quite a dramatic change from what we had seen in the past, especially if you compare it to the prior deep recessions like the ones that we saw in the middle part of the 1970s and again in the early 1980s. During the recovery from those recessions, real output growth in the United States averaged about 5.5% for the first 2 years coming out of the trough. 5.5%. During this recovery, growth averaged 2.1%. Now, why was that? Well, one of the big reasons is because of what happened during the downturn, or what actually caused and exacerbated the Great Recession, and that was a financial panic. Financial panics can be particularly problematic for government entities that are trying to counteract recessions. And they are so because if you take a look at the number of jobs were lost during the Great Recession, we lost almost 9 million jobs during the Great Recession, about 8.8 million to be more precise. We saw equity markets in the United States fall by about 54%. The value of equity markets fall about 54% from October 2007 until March of 2009. That is within a percentage point of the decline that happened during the Great Depression back in the late 1920s, 1930s. It turned around, but it was still a lot of money. And then think about this. The average value of a home in the United States declined on average by about 30%, if not a little more. Think of what that does to a household's ability to spend. So, going back to the two prior deep recessions in the middle part of the 1970s, early 1980s, they did not have to deal with the consumers that had balance sheets that were totally decimated. And as a result, it was consumer spending that led them out of those downturns. Personal consumption expenditures, which account for about 2/3 of economic activity in the United States, grew by about 5.5% during the recovery from those downturns. During this one, a little better than 2%, and it is largely a result of what happened during that financial crisis. Now, but the question is, when you get beyond that, why is the committee, the Fed Open Market Committee, why do we expect the economy to grow by just about 2% within that kind of narrow range moving forward? It gets back to what the economy is. The economy is people making stuff, okay? So there's two ways that you can change how fast we can produce more stuff. It's either in labor inputs or in productivity, and we'll talk about a little bit about that later. This graphic shows total non-farm payroll employment in the United States. I mentioned that we lost about 9 million jobs during the downturn. We have since created more than 15 million since the trough, more than 15 million jobs in the United States. So we're past the prior peak and then some. The unemployment rate in the United States is down around the lowest levels we've seen since early 2008, right around 4.7%. Hasn't changed a whole lot since the beginning of 2016, however, has flattened out quite a bit. And inflation, so this gets to our dual mandate. If you look at our dual mandate on the maximum employment front, we seem to be doing pretty well, 15 million jobs since the middle part of 2009. The unemployment rate down to about 4.7%. With regards to inflation, inflation is actually running a little too low right now. And folks, inflation that is too low is no more welcome than inflation that is too high. There's a reason for that, but I don't think I want to get into the gory details of it. But inflation that's too low is no better than inflation that's too high, especially when as a government body that is trying to target an interest rate, you have credibility in the marketplace. You want to have credibility as an inflation fighter. If you want to put yourself out there and have a target, you've got to meet that target. That's true if the inflation is too high or too low. So it's important that we get to 2%. Now, the reason that we haven't gotten to 2% lately is due to a couple transitory factors that have been a little more persistent, a little more prolonged than what most people had anticipated. Namely, the decline in energy prices, right? We saw oil prices fall from about $150 a barrel to less than $50 a barrel. They remain very low to this day. That has a ripple effect through the economy. But just as importantly, since the middle part of 2014, we saw a significant increase in the value of the US dollar. When the dollar increases in value, that makes the goods and services that we produce here more costly on the global marketplace. But at the same time, it makes the goods and services produced elsewhere cheaper here. So what happens is we see more imports and the price of those imports are lower. So it too puts downward pressure on prices. We've seen a lot of those pressures alleviating recently, so we expect that that trend is going to move back up toward the 2% target. Now, I know this is it's ungratifying that we've seen the economy growing at this 2% more or less pace over the last 6 to 7 years. But the economy is bound by a speed limit because at the end of the day, it is people producing stuff. So the question is, how many more people can we produce? And well, that's a production process, right? I mean, we basically got at least 18 years of training before you even have a worker who is in existence today, before that worker is ready to participate at any level in the workforce. So the question is, how much faster can we produce workers? Well, that's actually largely tied to growth in population. You know, in the 40-year history between 1972 and 2012, growth in the working age population in the United States averaged 1.2%. 1.2%. Growth in employment averaged 1.3%. So growth in the working age population, were you aware that there are roughly 95 million people in the United States who are more than 16 years of age who are not working and don't want to work in the United States today? 95 million people. We have about 140 million or so who are employed, but we have 95 million people in the U.S. who, for a variety of reasons, not participating in the labor force and don't want to. So labor force participation, not everybody is willing to participate. Please.
Where did you get that number?
Bureau of Labor Statistics.
Well, how did they figure out who doesn't want to work?
How do they figure out? Because all of these numbers that you look at when we're talking about these are based on what's called the household survey, which is the current population survey. It's actually conducted by the census, but the Bureau of Labor Statistics calls households in the United States, 60,000 households in the United States, and they ask them questions. In your household, how many people are 16 years or older? Of those people who are 16 years or older, how many are employed? If of those who are not employed, how many of them want a job? How many of them are available to work at a job? And how many of them have been looking for a job? That's how we arrive at the unemployment rate. But there's underlying questions then. If you're not working and you don't want to be working, why don't you want to be working? And then they have a separate category breakout for that. They have early retirees are in there. Getting an education is a big one. More than half of that 95 million is people who are 55 years or older, between the ages of 55 and 70. So more than half of those 95 million people, that strongly suggests those are early retirees or people who just kind of done working in the labor force. But you can all look that up online, the Bureau of Labor Statistics, bls.gov. Good question, though. So economists generally think that the labor force growth changes only slowly over time, and that's because it is a function of growth in the working age population. So we only have so many people. Now, what allowed employment to grow a little faster in that 40-year history than the growth in the working age population? Two big demographic factors. One is that the baby boomers were moving into their prime working years. So there's these prime working years between 35 and 54. That's the prime working years for all of us. And the baby boom generation was kind of coming through that in the late 1960s all the way up through the late 1990s. But there was another big factor that was at play demographically, and that was female participation. We had a lot more women entering the labor force to the point where today the labor force participation rate amongst women and men is really not that different. And importantly, since the Great Recession, the female participation rate has held up while the male participation rate has slipped a little bit. So ladies, thank you for enabling the economy to grow a little faster than it could otherwise. Please.
What are the economic implications for countries with really low birth rates?
Low economic growth. Russia, Japan, primary examples of this. They've got very slow growing economies because they simply don't have people to put to work.
So there's nothing they can do to
They can try to increase productivity, but there's a lot of factors that affect productivity that are beyond their control. And another thing that they can do, which Japan has been really bad about, is allowing immigration. The economy, in the United States, you hear a lot about the debate about immigration today. Well, we hear from employers around the Fifth Federal Reserve District that they can't find employees. And one of the factors they look to is changes in immigration that have taken place really since back in the attacks of September 2001. They put different immigration standards in place that has kind of limited the flow of immigrants to the U.S. But the U.S. has a faster growing indigenous population than what Japan certainly has, or that Russia has. When you have population actually declining, which I think it's still doing in Russia, you have fewer people to make stuff. And then there are other things that are heavily natural resource dependent economy that kind of limits how they want to grow. But that's the basic implication here. And that's a good question, though, because it leads to my following point, which is this. The Bureau of Labor Statistics estimates that the growth in the working age population in the United States out through 2022 is going to average just 0.5%. 0.5%. Now, between 1972 2012, that was 1.2%. So a considerable slowdown. And again, that is an implication on how much stuff we can produce. So the other way we can produce stuff is by enhancing productivity. This is where you folks come in. This is where Wake Tech comes in. Because one of the big factors that affects changes in productivity is skills attainment by its workforce. So what you're doing here today, as we will see in just a moment, by working toward building out your skill set, has benefits not just for you, it has benefits for society and our economy as a whole, and they are big benefits. So, but there are several things that affect productivity growth in the U.S. Technological innovation is one of them. You think about the advent of electricity or the combustion engine that had huge impacts on the way that we can produce stuff in the U.S. Industrial organization, this is oftentimes what we refer to as process technologies, changes in the way we do things in marketplaces, move things around, shift things around, to become more efficient in how we produce things. Think about the supply chain management, how big that has become in our economy today. It helps us do things more efficiently. Level of education, skills attainment is a big one. And then regulations, a relatively minor one. Regulations are often thought to have an adverse impact on productivity growth, but there are those on the other side of that equation who would argue that the measurements that we have available to us today don't take into account the true costs or the true benefits derived through regulatory processes. So it's a little sketchy as to which it is. Whatever the case may be, though, economists generally think that productivity is not affected by monetary policy. So money doesn't affect productivity. And I don't know if you noticed on the previous slide, money doesn't affect population growth either. I mean, when was the last time you heard somebody say, hey, Fed lowered interest rates by 25 basis points. What do you say we go have a baby? Doesn't happen. Please.
Okay, let's back up to monetary policy doesn't affect productivity.
Directly. It doesn't affect it directly. So if
I bought a new piece of equipment or whatever, because the interest rates are very low, that I would not have bought at 10% interest, then it did affect my ability.
So it would have indirectly affected it, yes. But keep in mind, when people purchase capital equipment, the fundamental factors, there are three fundamental factors. First and foremost is going to be your expectations for the demand of the goods and services that you produce. So if you expect that if you see an increase in demand for goods and services that you produce and you expect that that increase in demand is going to be sustainable, you are going to buy that to increase your productive capacity to be able to meet that demand. Secondarily is to replace worn equipment, right? Sometimes you just have to replace it. And third is the cost and availability of financing. So in an indirect manner, it can help help increase productivity, but that is an indirect and it's a very minor effect. Question, please.
You talked about how there's rising employment, but most of the jobs created are service sector jobs, minimum wage service sector jobs. The large job creators are big corporations used in other countries, and they sell to the U.S. and people buy their products and borrow money because there's practically 0% interest rates. So the economy is really confusing.
So, was that a question? So the embedded question in that is, I'm going to just attack, if I may, just the first one about the jobs that are being created. I mentioned that there were 15 million jobs that were being created, and the argument is that there's a lot of these jobs that are service sector jobs that aren't as good paying or aren't as high quality jobs as those that have been, and the argument usually is compared to those that were lost during the recession. Well, let me start by saying that happens during every recession. During any recession, there's a bunch of jobs that are lost as a result of the downturn in demand. So that is a natural consequence of a recession. At the same time, what happens is it shifts the balance of supply and demand in the labor market. You now have a much larger pool of workers who are available to work compared to the employers who are willing to hire them. So that's just the supply and demand commissions, and it sets prices in the marketplace. So quite naturally, prices are going to go down. During a deep recession like the one we saw recently, we would expect that to continue to be the case. So yes, that is absolutely true. Now, with regards to the 15 million plus jobs that are being created, yes, many of them are in the service sectors, but the service sectors have been creating the vast majority of jobs in the U.S. economy since the 1950s. So people like to look to manufacturing, the decline in manufacturing in the United States, if you will. There's not really a decline in manufacturing in the U.S. There's a decline in manufacturing jobs in the U.S. Because up until, we haven't gotten back to pre-recession levels yet, but we are producing more stuff. We are producing more manufactured goods in the United States than we ever have. We're slightly below the prior peak, but up through 2008, that was the case. And we will get there again. But we're doing it with fewer workers. But that frees up talent that goes and works somewhere else. So when we take a look at the service providing jobs, one of the biggest sectors that has been creating jobs in the U.S. economy since this recovery has gotten underway is this sector that we refer to as professional and business services. And this professional and business services sector covers a whole swath of things that businesses provide to other businesses. It can be architectural and scientific services, which are very high-paying jobs. It could be temporary help jobs, short-term temporary manufacturing jobs. But it runs the gamut. But as we will see in just a moment, the most important way that you can kind of protect yourself in any economy is to improve your skill set. So what you're doing here today has a big benefit to you, not only in terms of what you will earn, but how susceptible you are to an economic shock moving forward. So productivity, a lot of different factors affect productivity. So what I wanted to point out with this slide is once we put it together, we formalize this relationship. Real output, and forget about dollar signs right now. This is the amount of goods and services that we can produce as a society is going to be a function of how many people, the change in employment, how many additional people we have to employ, and changes in productivity. In the 40-year history between 1972 and 2012, it turns out that it was 1.3% change in employment, which, as we already stated, is related to growth in the working age population, and 1.8% average increase in productivity. Now, you take a look at what has been happening recently. This graphic shows real gross domestic product, so this is the real output of goods and services in the economy, broken out by its contributors, that is growth in productivity and growth in employment. A couple key things to note here. One is that generally speaking, economic growth in the U.S. has been on a downward trajectory since the 1970s. Generally speaking, our ability to produce more goods and services has been on a downward decline for the last 40 years or so. Well, why is that? You take a look at the components, the breakouts here, changes in productivity and employment. Most importantly, there has been a longer-term trend towards slower employment growth in the U.S. Since about the 1980s, early 1980s. That is largely a function of the baby boomers now flattening out. They've They've hit their prime working years. They are now moving out of the workforce, and women aren't coming into the workforce at a higher rate than what they had been coming in. So that takes the top off your growth rate. So we've seen employment growth in the U.S. on a downward trend. Moreover, we've seen productivity growth on a downward trend as well. So over the last 4 years, we've seen average increases in employment of about a little more than 1%, 1.5%, and we've seen changes in productivity of about 1 to 1.5%. That gets you to 2%. Since we think that these things change only slow over time, we expect that what we have been seeing in the last 4 years, in the absence of a compelling argument otherwise, we expect that what we have been seeing for the recent past is what we can expect to see in the near future. That's why we see these 2% predictions for growth.
So does that contradict the narrative that we're in recovery, or at least in a long-term sense?
Does it contradict the argument that we're in a recovery?
Yeah, if growth is...
If growth is 2%, absolutely not. We're still marching forward, but we can only march forward so fast. There's a speed limit on what we can do. So the way that you change that is a couple different ways. One of the most important and most fundamental ways that you can change that is making sure that you have an educated and skilled labor force, because that is going to help you in 2 ways. But I have to shift graphs for this. But before we move on, you had a question?
Yeah, I was just going to ask about the baby boom generation entering into retirement and how people used to be able to retire from the interest from the bank, and now that's not really possible anymore. So I was going to ask you what you think that's going to do to the economy in terms of people not being able to have as much funds to retire.
That's a good question. Can we revisit that at the end of I want to talk about this labor thing, and then we'll come back to that, okay? Don't let me forget. You're responsible for this. All right, so in any case, if you break this out, the things that you will notice is when you have periods of faster growth in employment, such as was the case in the 60s through the 70s, you can see stronger top-line gross domestic product growth. Similarly, when you have big changes in productivity like we saw in the 1990s, you can also see faster economic growth and this is real economic growth. You can see that happening, but when you're sitting in an environment where we've got growth in the working age population of 0.5% and productivity increasing 1%, you're going to grow at 1.5 to 2%. That doesn't mean you're not in recovery. And keep in mind, you're still creating jobs and lowering the unemployment rate. 15 million jobs, no matter how much those jobs pay, that's 15 million Americans with opportunities that they didn't have previously. So that's going to help us as we're going forward. Now, why is it important to get an education? Why is it? I'm sorry, please.
One of our students was asking, do you believe automation will impact the 40-hour work week?
Do I think that that automation will affect the
40-hour work week?
I think automation has already impacted the 40-hour work week by getting rid of a lot of folks who are working for 40 hours, because we think back, one of the factors that is affecting manufacturing more than anything else is not offshoring, not trade, it's automation in manufacturing. And that's a trend that is going to continue into the future. So the news when it comes to manufacturing jobs, so we're producing more stuff, but we're doing it with a lot fewer workers as we go forward. The good news for the workers who pursue manufacturing careers, though, is that they are now much more stable than they had been in the past, right? Because you get a job in manufacturing nowadays, though they're fewer, they're high paying, but they don't fluctuate like they have in the past because businesses are so more sophisticated. So I mentioned that one of the primary things we can do as a society to increase our economy's potential to grow is increasing by encouraging our population to enhance their skill sets by getting an education. And I've got a couple graphics that show the benefits to our economy and the benefits that flow to you as well. One of the big ones that flow to the economy is the more a worker invests in his or her own skill set, the more likely they are to participate in the economy to begin with. So if we take a look at participation rates by high school diploma, roughly 40%, if slightly more than that, actually are participating in the labor force. Those with a bachelor's degree or higher, up above 70%. And then everything in between. If you've got some college, no bachelor's degree, you get an associate's degree, you fall into this 60% plus range. So the more you enhance your skill set, the more likely you are to go out and seek a job in the first place and contribute to output growth in the United States. And as you may have heard, there's been a big decline in the labor force participation rate in the United States over the past several years. That's one of the reasons that the economy is growing so slowly. And again, it gets back to demographics, right? The baby boomers are going into retirement. The female participation rate has flattened out. And with that, we've seen a big decline in labor force participation rate. That means the smaller segment of society is actually going out and participating. You had a question, please.
A couple of questions that kind of went with each other. You mentioned earlier things countries could do to boost things like participation, and you said Japan do some along with immigration laws. So my question tying into that would be, number one, with all the immigrants that are participating in the labor force not being counted in these statistics, do you think it would drastically change? And my second question is, with all these immigration laws coming in and that we're having yet to have, do you think that would drastically change the labor force positively or negatively?
Okay, so the question for those of you who could not hear it, including those who are participating via the internet, really the immigrants, the number that are participating but really aren't being counted. I didn't really catch what the question was out of that, though.
So if they were to be counted in the participation or in the unemployment rate, would that affect it drastically, negatively, or positively? Yeah,
so I guess there are estimates out there that there's maybe 10 or 11 million undocumented illegal immigrants who are in the United States. It doesn't break it out by whether they're participating, whether they're working or not. Would it affect the numbers? Yeah, it would affect the numbers. I don't think it would have that great of an impact on the overall numbers. But I will tell you this, the one thing that we hear more than anything, the chief complaint about the economy that we hear from businesses throughout our district is they can't find workers. They can't find workers at virtually any skill level to fill open positions. That's a predominant concern that folks have. So when you're thinking about tightening up immigration laws, you want to do it sensibly. To make sure that businesses can continue to expand and find the workers that they need while balancing out the need, of course, to keep our country safe. I'm going to move along real quickly. I saw we had a question in the back. We'll get back to it. We'll hold it toward the end. I want to get through a couple more slides because these now start to talk about what the benefit is to you in enhancing your education. This graphic shows median weekly earnings, and these are in real dollars. In other words, we adjusted it for inflation by educational attainment level. The lowest bar here shows that average weekly wages for those who have less than a high school diploma, and then the highest one shows those who have a bachelor's degree or higher. The key thing to notice here is that over the last 40 years, wages for lower skill levels have been actually declining in real terms on average. And as you further your education, they seem to be increasing. The big bang seems to occur when you get to that bachelor's degree level. That is not to say that pursuing an associate's degree is a bad thing. It's absolutely a good thing. And you can always do something else if you choose to, right? You can always enhance your skill set. But the two key points on this is, one, is that wages are much higher for educated workers versus uneducated workers, and the gap is growing. So the further you fall behind on education today, the further you're going to fall behind in your wages as you go out into the future. And this is an important one as well. This is unemployment rate by educational attainment. So the lowest line shows workers with a bachelor's degree or higher. The highest line shows workers with less than a high school diploma. Enhancing your own skill set, you're building in flexibility to your skill set, makes you much less vulnerable to shocks in the economy. Take a look at the unemployment rate during the Great Recession. At its peak, for workers with less than a high school diploma, the unemployment rate was more than 15%. For those with a bachelor's degree or higher, it never hit 5%. So not only do you earn more money, you're more likely to participate in the labor force, you are much less susceptible to economic shocks in the future. And folks, we will see more recessions in the future. The business cycle lives. But key considerations when you're thinking of building out our labor force one at a time. Number one, most important, finish what you start. It is incredibly important that once you undertake, once you get on that highway, you need to get to your destination for your investment to pay off. Whether you're going for an associate's degree or a bachelor's degree or a certificate, you must finish it to reap the rewards. An ancillary and just as important point, especially when you considering you need to complete what you're doing, you need to prepare for the journey. Make sure you know what you have available to you. Make sure you know what you want to do. Make sure you know what your options are. Because it does you no good to get on the highway to Columbia only to get off somewhere around Fort Mill, South Carolina, because you're not getting to your destination. If you prepare, get to where you're going, wherever that may be. And recognize that the decision earlier in life, do it now. Don't be like me. I waited till I was a relatively old man. I got my first real job in economics when I was more than 30 years old, because I decided I didn't know what I didn't prepare for the journey. And as a result, I fluttered around for 10 years trying to figure out what I wanted to do. And it's cost me. I'm happy where I am, but certainly it cost me. So keep these things in mind. Finish what you started. Prepare for the journey. Do it early in life. With that, I'm going to stop. We had questions. You had a question about?
I had the question about interest rates in terms of retirement and how the generation is getting to that age. And there's no longer the ability to put money in the bank and retire on interest like they used to do. So how do you think that's going to affect the future economy in terms of that huge generation retiring and maybe not having a fund?
Just in time. Got the microphone just in time. Does anybody have an easier question? So I got to answer that. So the question is low interest rates, really. So with interest rates being as low as they are, it certainly has an allocation effect in the economy, right? People who are on the verge of retiring or are retiring can no longer just sit there, drop their money in a certificate of deposit or bank, expect to earn some kind of interest that's going to lead to an enhanced lifestyle after retirement. So what oftentimes happens is that money starts seeking yield. So they will leave the kind of, the money will start leaving banks or certificates of deposit or even some short-term money market mutual funds, and they'll start seeking higher returns elsewhere that at times can be, usually anything that pays a little higher reward is more risky. This is not to say that it's risky, but it's more risky. So you see a lot of that taking place. During the course of the Great Recession, when asset prices were actually declining, we were hearing just some of the most interesting stories about where people were putting money as an investment. For example, I ran into one person who said, I'm not getting any money there, I'm losing money in my equity markets, I pulled that money out, I'm now investing in old muscle cars. Because people who had muscle cars were selling them off in the bad economic environment, they were seeking some return, they went out and purchased a hard asset that they thought they could sell off later. But it leads to, and I want to stress, not risky, but riskier behavior on the part of folks. So whereas once you might wanted to have something like 80% of your investment portfolio in these relatively risk-free assets, you might cut that ratio to 60, 70, maybe even 50%. So you do see some allocation going on. Good question. There was one in the back of the room from earlier, please.
You had commented about the employers that you've been talking to.
Yes.
You suggested that the employers say they can't find people with the skills that they want.
That is correct.
It's like there's a shortage of skilled workers. If that's the case, why aren't wages rising for those?
Good question. So the question is, the complaints about worker shortages in the economy suggest that wages should be rising to fill those open positions. So let me take a step back and clarify. When we say that employers are having a hard time finding workers with the right skill set, they are finding it difficult to find the right workers with the right skill sets in the right locations. So there seems to be a variety of things that are kind of jamming the labor matching mechanism in the United States today. One of them is geography. We still have some legacy effects from the Great Recession. So if you were to go up to Detroit, Michigan, for example, a worker up in Detroit, Michigan who may have the skill set to fill an aerospace position down in Charleston, South Carolina, but they're underwater on their home in Michigan, they can't just necessarily walk away from it, and oftentimes that leads to some lack of geographic mobility. But you would expect that wages would rise to meet, to fill those positions, but you've got two problems here. One is that prices are increasing only very slowly, right? Inflation's very, very low, and productivity is rising only very, very slowly. So that places somewhat of a constraint on what you can pay. If you can't increase prices, and if your workers can't be more productive, then you can't hire them by offering them higher wages because you can't raise prices. And so it's kind of a circular scenario there. But there's still, the requirements for jobs are changing so rapidly nowadays as well that it's almost as if the whole educational infrastructure needs to adapt more quickly, and it hasn't traditionally. Is there something on this side of the room? I'm going to go to you, please. Ma'am? Miss? How does immigration help an economy? By putting bodies into it. So if you've got so we know through our census how many people there are in the United States. And it's a fairly easy task to forecast in between censuses because we know that, we have so many 16-year-olds. We know that next year those 16-year-olds are going to be 17-year-olds and on down the line. So you can make a fairly educated guess about how big your working age population is. So now, if we take that as a given, and we look at that and we can say, well, in the absence of any new people coming into the economy, and this is true not just of the U.S. and immigrants coming from overseas, but people moving around our region. We have people in cities such as Charleston, and actually here in the Raleigh, the Triangle area, that the in-migration, we need people moving to the area to be able to satisfy the demand, the increased demand for the goods and services that are being produced here. So if you know that your population is growing only so fast, especially the working age population, which we've got a pretty good handle on, the only way for it to grow faster is attracting people from elsewhere. You want to have, you want the people who are coming from overseas to be productive, right? You want people who can come in and can contribute to society and can contribute economically. Otherwise, there's no sense in firms hiring them. Question right behind him, please.
You mentioned earlier that the access
it is tax dollar, yeah.
the taxes for yourself. Can you explain how the Federal Reserve is funded?
That's a good question. How is the Federal Reserve funded? So the Federal Reserve basically earns almost all of its money on fees for services that we provide to banks and bank holding companies, and on our investment portfolio, which today is quite sizable. We've got about $4.5 trillion on our balance sheet. A lot of that, don't shake your head there, that's
real money.
that's real money. Yeah, it's about $4.5 trillion in investments that we have in mortgage-backed securities and treasuries, both short-term and longer-term. So we earn interest from those, and that money helps to fund our operations. Now, and in another interesting side effect of that debate between the public and private sector back when we were created, the Fed cannot earn a profit. So any profits that we earn, and we do earn profits, but we have to turn those over to Treasury. Good question. Please.
After the recession of 2008, the Federal Reserve dropped interest rates to 0%. It's been at zero for around 8 years. So there's no incentive to save, or there's an incentive to borrow for free. And the national debt doubled in the last 8 years. So what happened to interest rates?
So the question is that interest rates, the Federal Reserve lowered the targeted rate on federal funds to effectively the zero lower bounds. And with interest rates so low, it has encouraged people not to save, but to spend. And during that time, the national debt has more than doubled. And what impact might rising interest rates have on that? And I'm going to try and answer this very, very quickly because I see we're out of time. What generally happens, first of all, The national debt, the national deficit is a result of fiscal policy, right? That's decisions made by Congress and, well, actually Congress, they hold the purse strings. That's in the realm of fiscal policy. We don't have anything to do with that. The impact of higher interest rates would have kind of a predictable effect on that. As interest rates start to rise, then the government has to pay more in debt service to satisfy those higher interest rates. I'm going to, should I stop here? Or, I still see lots of hands up and not everybody's running out. So. If you keep asking questions, I'm happy to answer them. You had a question, please.
You had mentioned earlier that if you have less than the 2% inflation, it is just as bad as higher inflation.
Yeah.
Why is lower inflation bad?
Why is lower than expected inflation bad? So we're getting back to his point. We have 0% interest rate environment. We think that people borrow money based on their expectations for real interest rates, not the nominal interest rates. So think about this, if the real interest rate is the nominal interest rate minus the rate of inflation. So if you're at 0 and inflation is 2%, then you've got a negative 2% interest rate. If it actually comes in lower than that 1%, then you've got a negative 1% interest rate. So actually the real rate of interest actually increases. Does that make sense?
Good afternoon, I'm Lynn Cassatt with Career Employment Resources. Students, please turn in your evaluations for this session because we have a small prize inside for you. And I'm trying to draw here for a portfolio, which will come in handy at one of our 6 upcoming career fairs. So the odds are including these happy friends that left us. So let's see. 006406. 006406. 006111. Did you get it? Did you have that last one? Okay. 006111. 006423. Yep. Okay, thank you. Thank you. Thank you very much.
Should I keep answering questions? I mean, it seems like we've still got them.
Sure. Any questions? Go ahead.
Please.
While you've got Rick.
With many nations speaking about dropping the U.S. currency as a reserve currency, what monetary policy is proposing to counteract that?
Yeah, so there's a lot of talk about dropping the U.S. as the base currency, but the question is always, where are you going to find a better base currency? I mean, when you're thinking about what you want to base it on, you're looking at institutions, legal, political, property rights, respect for property rights, all of these things, solid financial system, where else are you going to find that in the world? But I don't think it impacts how the U.S. is going to conduct a monetary policy regardless. Please.
You said what else can you base the currency on? You can base it on gold. I mean, gold is anti-inflation. There's no inflation in gold. After 1973, when the U.S. put up the gold standard, the dollar lost 97% of its value. So a country can use gold and silver as currency. You don't need to use gold.
So, getting back to for those of you who did not hear that, we should the idea of going back to the gold standard has gained currency, if you will, in the current economic environment. So going back to the gold standard is basically going back to a commodities-based economy, right? So we want to tie, instead of having a fiat currency, we want to have a commodity-backed currency that is based on some value we assign to gold. Now, the big problem with gold is the problem that virtually every economy who is overly reliant on commodities falls victim to, and that is that the benefactors of the people who benefit from a gold-based or any commodity-based currency is the people who can produce that commodity. That means that there are no rewards to technological advances. There's no rewards to productivity growth. You mentioned that the dollar has lost 97% of its value. So, yes, it has. But over the course of time, we've had a couple bouts with inflation. We got that problem pretty much under control since the middle part of the 1980s. But again, getting back to what an economy is, which is people producing stuff, it's how many people and how much stuff they can produce. over the course of the past several decades, most economists figure that based on the fundamentals in growth, that is growth in the working age population and labor force participation and changes in productivity, that the economy is capable of growing so fast. And we have basically been keeping up with that with a 2% rate of inflation. Now, the 2% rate of inflation over the course of time absolutely will erode the value of the dollar. But if you keep it at 2% using the rule of 72, everybody familiar with the rule of 72? Divides your inflation rate into 72, it takes gives you, what's that? I don't know. I just refer to it as the rule of 72. It yields in years the number of years it would take for your currency to lose half its value. So when you've got inflation running about 2%, 72 divided by 2% is 36 years. If inflation rises to 4% and 6% and onward.
Basically, every year the Fed wants to increase the cost of living on people.
No, it doesn't want to increase the cost of living on people. What's that?
And then inflation, the rise of cost of living.
There's inflation, we're always going to have some inflation. There's a good reason why we have some inflation. One is because there's some inherent error in the measurement of these things. And we don't want to get too close to zero to the point where prices start to drop, because if prices start to drop, then they have adverse impacts on economic activity as well. One of the most important thing about it is if you expect prices to drop, you hold off on purchases because what you can purchase today is going to be cheaper tomorrow. And it has these distortionary effects on the economy. So we want to have a little bit of inflation. And the Fed has determined that with inflation at 2%, that the economy has been capable of growing at its potential rate of growth based on the fundamentals. That's why we have it at 2%. We don't want to see it at 3%. We don't want to see it at 4%. But 2% is acceptable for the economy to continue to growing at a pace. Now, does that mean that people are falling behind? No. I mean, if productivity growth exceeds that, then we're increasing our standard of living over the course of time. That hasn't been the case over the past couple of years, but we're living through a rather interesting time in our economic history.
Thank you.
We got one more question, and then I'll leave you alone.
Two questions on accountability, and the first one is because the Fed is not funded by taxpayer dollars, who are they accountable to? Essentially, who owns the Fed?
Congress. We are accountable to Congress. So Congress writes the laws. The Board of Governors oversees all of the operations of the system as a whole, including the 12 district banks. They are responsible for making sure, they are responsible for oversight of the Federal Reserve in every respect, but with the exception of the conduct of monetary policy. So that everything that we do outside of monetary policy is subject to congressional oversight.
Okay, and the second one has to do with the Dodd-Frank Act, which that created, Financial Stability Oversight Council, right? But that's made up of 10 people, chairman of the Housing Department, chairman of the SEC, everything like that. So how can that ensure accountability when all of those people are tied into the housing market? And how can we make sure that we don't have another 2007, 2008 crisis where we're selling subprime mortgages on the stock market?
You actually just educated me because I did not have that in-depth knowledge of the Oversight Council.
Okay. I just think it would be a better idea to reinstate Glass-Steagall, but that's fine.
And the gold standard? Okay, now I'm done with that question that I can't. I've run out of answers. I'm done. Wait, we got now one more.
Illuminati taking over.
When's the Illuminati? What time is it?
Thank you, Rick.
Thank you.